Now let's talk about the accounting for depreciation, in particular using straight line, units of production, or double declining balances. So let's talk about this. Now, remember what depreciation is. We want to match the expense against the revenue generated from using an asset. Again, it's the matching concept, and we want to recognize the revenue recognition and the expense recognition also, and we want to match the two together in the period that it was generated. So in this case, it mentions here that all assets except land wear out as they are used, and that's very, very true. And then some assets can become obsolete also as they wear out or before they wear out. Okay? So again, if there's a newer asset, a newer, better, more efficient asset that's out there, your old asset can become obsolete now because it's just not profitable or it's just not useful to have that asset in your possession anymore. So again, we'll take a look at depreciation on this one. Again, we've got some definitions on some of these asset definitions. So again, we'll take a look at that. Now, let's talk about computing depreciation. As I mentioned in Chapter 3, there's three things that you need to compute depreciation. You need the capitalized cost, you need the estimated useful life, or how long you're expecting to use that asset, and something called an estimated residual value, which at the end of its useful life, what's the value of that asset going to be? So again, we need cost, useful life, and residual value. Now, another definition out there is the depreciable cost that we're going to be looking at is going to be my cost of the asset minus its residual value, and that's going to be depreciable cost. Now, depreciable cost is something we're going to be really looking at when we look at straight line and units of production depreciation methods. The double declining balance method, it's going to use a different thing, but we'll take a look at this. Now, with depreciation, the three most commonly used are going to be straight line, units of production, or double declining balance. Now, the information that you have, the data for the truck down below, you got the cost of the truck, you've got the estimated residual value, you've got depreciable cost, estimated life in years, and estimated life in units. Basically, this is all you need in order to compute depreciation for all three methods. So we're going to be using different bits of information when we're computing out depreciation expense. But as long as you have these items here, this is all the information you need to compute depreciation expense. Now, what I want to talk about first, I'm going to talk about all three methods. But what I want to talk about first is the straight line method. Now, the beautiful thing about straight line is once you compute it for your first year, it's going to be the same amount for the following years until the end of its useful life. So you compute it once, you're all set and ready to go. Now, in this case here with straight line, it allocates an equal amount of depreciation to each year. And normally it's computed as cost minus residual value divided by useful life. So in this case, we've got $41,000 minus $1,000. So my depreciable cost is going to be $40,000. We'll divide that by its useful life of 5 years, and we come out with straight line depreciation of about $8,000 per year. Now, the entry to record the depreciation expense is always going to be a debit to depreciation expense and a credit to accumulated depreciation. It's never a credit to the actual asset account. It's always a credit to a contra asset account or an offset account against the asset. Now, straight line depreciation, out of all three methods, probably about 90% of the companies out there are using straight line depreciation. Why? Because it's easy to use. And once you set it up, it's going to be the same amount every year. So again, with straight line depreciation, it gives you a sense of consistency also, that you're really going to have the same amount out there every year. So again, it's going to produce a very good consistent value out there that at least companies can always take a look at and really count on and rely that, yes, my depreciation is going to be that number every year. Now, depreciation expense is always recorded on the income statement, And the other thing we're going to have to take a look at is the book value of the asset. So the book value of the asset is always the cost minus its accumulated depreciation. Now, the book value of the asset is always going to change every year. The cost of the asset will always stay the same, but the accumulated depreciation is always going to increase every year because of additional depreciation expense that's taken in that year. So again, accumulated depreciation is always going to increase. Now again, with the net book value, it's always the cost of the asset minus its accumulated depreciation. So in this case here, cost minus accumulated depreciation, I'm going to get a net book value. So the net book value on this asset is always going to go down every year. Now, this is a straight line depreciation schedule. And so you can see here at the start of the year, we've got an asset cost of $41,000. Now, my depreciable cost is always going to be my cost minus my residual value. And again, that's going to be $40,000, as you can see, divided by my useful life of 5 years. Now, my depreciation expense is going to be $8,000 every year for 5 years. Now, on the accumulated depreciation side, what we're going to be doing is the accumulated depreciation number is always going to increase by $8,000 a year, okay, until we hit $40,000. Now, the accumulated depreciation of an asset can never exceed its depreciable cost, okay, so that's a good fact to know. Now, over on the book value side, this is my cost minus my accumulated depreciation. So, again, I'm going to be taking out, $8,000 out of my book value every year until we hit year 5. And then we come up with a residual value of $1,000. The other tip I'm going to give you is book value, you can never depreciate below the residual value. Once book value equals residual value, you cannot take any more depreciation. So 2 things out there. When the book value equals residual value, no more depreciation expense can be taken. And when the depreciable cost equals the asset's accumulated depreciation, no more depreciation can be taken. So again, 2 very important facts out there. Now, number 6, which of the following requires businesses to record depreciation? Well, this one here is the matching principle. It's not revenue recognition because there's no revenue. Cost, we're looking at the cost of an asset. D, on the going concern, this is where we're feeling that the business is going to be in existence for quite a long time period. So in this one here, the best answer on this one is B. It's going to be the matching principle. Now, the expected value of an asset at the end of its useful life, is it its book value? Is it the residual value? Is it the carrying value? Or is it the market value? In this case here, this one's going to be B, residual value. This is a perfect definition out there for residual value. Number 8. On January 1st, 2018, Jordan acquired a machine for $1 million, or $1.1 million. The estimated useful life of the asset is 5 years. Residual value at the end of 5 years is estimated to be $61,000. Calculate the depreciation expense per year using the straight line method. Well, let's see. We've got a machine out there for $1.1 million. We've got a 5-year useful life and a residual value of $61,000. Well, let's figure out depreciable cost. Now, my depreciable cost on this is going to be cost minus residual value. So in this case, it's going to be $1.1 million minus $61,000. And then I'm going to divide that by its useful life. So again, I'm going to divide, my useful life is going to be 5 years. So 1,100,000 minus 61 divided by 5, that's going to come out with depreciation expense via straight line of $207,800. Again, this one's going to be B.